Intel reported $13.577 billion in Q1 26 revenue. AMD reported $10.253 billion. Every traditional scorecard says Intel wins. Bigger revenue, bigger brand, bigger history. But here is what the traditional scorecard does not show you. Intel posted a GAAP net loss of $3.728 billion that same quarter. AMD posted GAAP net income of $1.383 billion. That is a combined swing of over $5.1 billion between two companies supposedly competing in the same industry. And if that number does not make you stop and reconsider everything you thought you knew about this rivalry, nothing will. Let us start with revenue, where most analysts start and most investors stop. Intel's 7% year-over-year revenue growth sounds reasonable until you place it next to AMD's 38% year-over-year growth. AMD has already guided Q2 26 revenue at approximately $11.2 billion, implying 46% year-over-year growth. Intel guided Q2 at a midpoint of $14.3 billion, a modest 8% to 12% improvement. The math is relentless. At these trajectory differences, the moment AMD's total revenue surpasses Intel's is not a distant scenario. It is a near-term mathematical probability. This is a simple rule, but it is incredibly powerful. For your investing strategy, trajectory beats snapshot every single time. The question is never where a company is. The question is always where it is going and how fast. Now, Intel's defenders will correctly point out that the GAAP loss is dominated by non-cash items, a $4.07 billion restructuring charge and a $1.09 billion mark-to-market loss on a government-related equity instrument. Strip those out, and Intel's non-GAAP net income reaches $1.485 billion, actually slightly above AMD's GAAP net income. That is a fair point, but here is where the story becomes genuinely dangerous for Intel holders. AMD's GAAP and non-GAAP earnings tell essentially the same story. The gap between AMD's GAAP earnings per share of 84 cents and non-GAAP earnings per share of $1.37 is explained by normal, transparent adjustments: acquisition, amortization, and stock-based compensation. Intel's gap between GAAP earnings per share of negative 73 cents and non-GAAP earnings per share of positive 29 cents is a $1.02 per share chasm, filled with impairments, derivative losses, and restructuring charges that, while individually labeled non-recurring, have become a recurring feature of Intel's reporting landscape. Once you grasp this, you will start to look at financial reports in a completely new light. When a company consistently asks you to ignore its GAAP results, that is not accounting sophistication. That is a signal that the underlying business reality is more expensive than the headline narrative admits. If there is one number that ends this debate, it is free cash flow, the actual cash a business generates after all its spending. AMD generated $2.566 billion in free cash flow in Q1 26, a 25% free cash flow margin. Management called it a quarterly record. Year over year, that figure surged 253% from $727 million to $2.566 billion in 12 months. AMD's operating cash flow ran 2.14 times its GAAP net income, confirming those earnings are genuinely cash-backed. Intel's adjusted free cash flow? Negative $2.016 billion. Intel, with $13.6 billion in quarterly revenue, consumed $2 billion more cash than it generated after capital expenditures. It is funding its transformation through partner contributions and government incentives that fell sharply from $819 million to just $107 million year over year, alongside a short-term investment portfolio that shrank by $7.6 billion in a single quarter. That is not growth financing from strength. That is survival financing from necessity. The balance sheet confirms the story, and this is something you can easily check for yourself in any quarterly filing. AMD carries $3.224 billion in total debt. Its debt-to-equity ratio, a measure of how much a company owes relative to what it owns, stands at just 0.05 times. Combined with $12.347 billion in liquid assets, up 69% year over year, AMD's balance sheet is a strategic weapon. Intel carries $45.031 billion in total debt, roughly 14 times AMD's debt load, with a debt-to-equity ratio of 0.40 times. That ratio alone is not alarming, but Intel's debt exists alongside negative free cash flow and $4.963 billion in quarterly gross capital expenditures. The distinction matters enormously for your fundamental analysis. AMD's balance sheet gives it options. Intel's gives it obligations. The artificial intelligence data center race is where this rivalry becomes most consequential for investors. AMD's data center segment generated $5.775 billion in Q1 26, up 57% year-over-year, powered by EPYC processors competing for server dominance inside AWS, Google Cloud, Microsoft Azure, and Tencent, and by Instinct GPUs accelerating into artificial intelligence training workloads. Meta's plan to deploy up to 6 gigawatts of AMD Instinct GPUs represents multi-year demand lock-in from one of the world's largest artificial intelligence spenders. Intel's data center and AI segment grew 22% year-over-year to $5.051 billion. A genuine result worth acknowledging, but at 57% growth versus 22% growth, AMD's engine runs more than twice as fast, and AMD has not yet fully ramped its MI450 GPU series. The research and development comparison deserves your attention. AMD spent $2.397 billion on research and development in Q1 26, growing that investment at 38.7% year-over-year, precisely matching its revenue growth rate. That discipline signals a company investing to extend an advantage. Intel spent $3.375 billion, 41% more in absolute terms, but actually cut that spend 7% year-over-year as part of its restructuring. Think about what that means. Intel is reducing research investment precisely when it most needs process technology breakthroughs to validate a foundry business losing $2.437 billion per quarter at the operating line. Annualized, Intel Foundry is consuming approximately $9.7 billion per year. No break-even timeline has been disclosed. Intel's own filing states that its next-generation process node could be paused without sufficient external customer commitments. As an investor applying rigorous stock market analysis, that sentence alone should command your full attention. Gross margin, the percentage of revenue a company keeps after its core production costs, tells the final chapter of this story. AMD's gross margin of 52.8% GAAP in Q1 26 is guided toward 56% non-GAAP in Q2. Intel's GAAP gross margin sits at 39.4%, approximately 1,400 basis points lower, and is guided further down to 39.0% non-GAAP in Q2. A 200 basis point sequential decline with no explicit management explanation provided. For any value investing framework, expanding margins signal a business gaining pricing power. Contracting margins without explanation signal the opposite. Intellectual honesty demands addressing AMD's real vulnerabilities. This is not a one-sided story. AMD's inventory of $8.045 billion represents nearly 79% of a full quarter's revenue, elevated by historical standards. Stock-based compensation reached $487 million in Q1 26, the largest single bridge between GAAP and non-GAAP earnings per share. And the Meta commitment, while extraordinary, creates customer concentration risk in AMD's most critical growth segment. Every major hyperscaler, Meta, Google, Amazon, Microsoft, is developing proprietary artificial intelligence silicon. As those internal programs mature, they represent a structural headwind that AMD's data center growth rate cannot afford to ignore. Comprehensive stock market analysis always demands both sides of the ledger. So, how does the bigger company become the weaker investment? The answer is in the data. Intel's revenue lead is real but eroding. Its non-GAAP recovery is genuine but financed by balance sheet liquidation rather than organic cash generation. Its foundry ambition is bold but currently consuming $9.7 billion annualized in operating losses with no disclosed path to profitability. AMD is generating $2.566 billion in free cash flow per quarter, a record. Its debt-to-equity ratio is 0.05 times. Its data center segment is growing at 57% year-over-year with multi-year hyperscaler commitments already secured. Its non-GAAP operating margin of 24.8% sits well above Intel's 12.3%, and that gap is widening. Here is the prediction grounded in this fundamental analysis. Within 6 quarters, AMD's total revenue will surpass Intel's. For your investing strategy, the data makes the case with unusual clarity. AMD is not just winning this rivalry, it is redefining what winning looks like in the artificial intelligence semiconductor era. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything. Into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.